Path to Greatness English. Level 2 Intermediate English Learner Edition. Learn English through Warren Buffett. Price is what you pay, value is what you get. Warren Buffett was born into economic uncertainty, but what shaped him was not simply poverty or scarcity. It was observation. From an early age, he watched how adults reacted to financial instability. The Great Depression was not only an economic collapse, it was a psychological event. Families did not only lose money, they lost confidence. As a child in Omaha, Buffett absorbed more than numbers. He absorbed behavior. He noticed how fear influenced decisions. He saw how people sold assets quickly when prices fell. He observed how anxiety spread through conversation. The economic environment became his first classroom. But instead of internalizing fear, he internalized curiosity. Why do intelligent people make irrational decisions when prices change? Why does price movement affect emotions so strongly? These early observations planted the seeds of a deeper inquiry. Buffett was not only counting coins, he was studying decision patterns. His early business activities, selling Coca-Cola, delivering newspapers, installing pinball machines, were not simply about earning small profits. They were experiments. Each activity tested a principle. If he bought at one price and sold at another, he could measure margin. But margin alone was not the whole story. He began to sense that some transactions created temporary gain, while others created sustained return. This distinction is subtle but important. A transaction may produce profit. An asset may produce value. The difference between profit and value would later become the foundation of his investment philosophy. As he matured, Buffett developed a habit that separated him from his peers. He did not focus on how much something cost in isolation. He evaluated what that cost produced over time. He tracked results. He compared outcomes. He analyzed patterns. For example, his newspaper routes were not simply delivery jobs. They were systems. He learned that certain neighborhoods generated more stable income. He learned that reliability built customer retention. He recognized that discipline in small routines created predictable returns. He was unconsciously building a mental model. Value equals performance over time. Most people focus on price because it is immediate. Price is visible. It flashes on screens. It appears in advertisements. It changes daily. Value, however, requires patience. It requires evaluation. It demands emotional restraint. When Buffett purchased farmland as a teenager, he was already thinking in terms of productive assets. The land had a purchase price, but what mattered more was its capacity to generate income year after year. He did not need to farm it himself. He needed it to produce yield. This marked a transition in his thinking. He was moving from transactional behavior to structural thinking. Instead, Graham articulated what Buffett had intuitively sensed. The market often misprices assets due to emotion. The concept of intrinsic value resonated deeply with him. It offered language for something he had long observed. Price is an opinion. Value is an analysis. This distinction would define his adulthood. When he bought his first stock at 11 and watched it decline before recovering, he experienced firsthand the volatility of price. His emotional reaction was natural. He felt uncertainty. He wanted resolution. He sold once he saw a modest gain. Later, when the price continued rising, he realized that impatience limits value capture. This moment became a psychological lesson rather than a financial one. Short-term relief often sacrifices long-term value. This pattern would repeat in markets for decades. Buffett's early life was not dramatic in the traditional sense. There were no extreme hardships, no sudden transformations. Instead, there was accumulation. Accumulation of observation. Accumulation of habits. Accumulation of disciplined thinking. And this accumulation created a foundation. When he studied under Benjamin Graham at Columbia University, he did not simply memorize formulas. He integrated philosophy. Graham emphasized that investors should view stocks as partial ownership of real businesses. Buffett embraced this perspective completely. If you own part of a business, temporary price fluctuations become less intimidating. But this mindset requires maturity. It requires emotional distance from daily noise. It requires confidence in analysis rather than reaction. Buffett was uniquely prepared for this discipline because his childhood had trained him to observe before acting. The boy who counted bottle caps had become a young man who counted cash flows. And at the center of his developing philosophy was a simple but powerful differentiation. Price is what you pay. Value is what you build over time. This idea would evolve, deepen, and expand in the next stage of his life. As Warren Buffett moved beyond his academic training and into the early stages of his professional life, his philosophy began shifting from observation to application. It was no longer enough to understand the difference between price and value in theory. He now had to test it in real financial markets. Working under Benjamin Graham gave him exposure to disciplined analysis, but it also exposed him to a limitation. Graham often focused on companies that were statistically undervalued, businesses selling below liquidation value or with large cash reserves compared to their stock price. These were logical investments, but many were mediocre businesses. Buffett began asking himself a more refined question. Is buying something cheap enough? Or should the quality of the business matter just as much as the discount? This question marked the beginning of a structural evolution in his thinking. Under Graham's system, the emphasis was on margin of safety. Buy assets below intrinsic value and reduce downside risk. Buffett mastered this approach, but gradually he realized that some businesses, even when purchased cheaply, offered limited long-term expansion. They were inexpensive for a reason. He noticed that certain companies possessed characteristics beyond balance sheet strength. They had durable competitive advantages. They had brands that customers trusted. They had predictable earnings growth. These qualities created sustained value, not just temporary statistical opportunity. The shift was subtle but profound. Cheap assets can provide short-term profit. Strong businesses can provide compounding value. This idea did not appear suddenly. It developed gradually as Buffett compared outcomes across multiple investments. He studied patterns over time. He observed that high-quality companies reinvested earnings effectively. Their internal growth multiplied shareholder value even without frequent buying and selling. The psychological implication was important. If you own an excellent business, you do not need constant action. Patience becomes rational rather than passive. Why trade frequently if the underlying asset grows steadily? This realization reduced the temptation of activity. Many investors confuse motion with progress. Buffett began understanding that disciplined inactivity can outperform emotional reaction. When he returned to Omaha and launched his own partnership, he implemented what he had learned. But his strategy was no longer purely Graham-style statistical buying. He began integrating quality assessment into valuation analysis. He examined management integrity. He evaluated capital allocation decisions. He studied long-term competitive positioning. These factors are not immediately visible in price charts. They require interpretation. They demand qualitative judgment alongside quantitative review. Here, the difference between price and value deepened further. Price reflects supply and demand in the moment. Value reflects structural strength over time. Buffett's emerging philosophy required emotional independence. Markets often reward excitement temporarily. Speculation can create rapid price increases. Observers may assume that rising price equals increasing value, but Buffett separated the two deliberately. He did not avoid growth companies. He avoided unjustified enthusiasm. During this phase of his life, he refined another core principle: circle of competence. He recognized that understanding is itself a form of value. If you invest in businesses you cannot explain clearly, you increase uncertainty. What do I truly understand? Where is my knowledge strong enough to make rational decisions? These questions limited his universe of potential investments. But limitation created clarity. Many investors attempt to predict every industry. Buffett focused only on those he could evaluate deeply. He preferred insurance, consumer goods, and other predictable sectors. Predictability increases the accuracy of value estimation. He also began emphasizing the role of time horizon. Short-term market participants operate under pressure. Quarterly earnings reports influence perception. News cycles create urgency. Buffett stepped outside this rhythm intentionally. He measured opportunity in years, not weeks. The longer the time horizon, the more price volatility becomes irrelevant. This insight strengthened his emotional discipline. Temporary market declines no longer triggered anxiety if intrinsic value remained intact. Instead of asking whether price would recover tomorrow, he evaluated whether the business would remain strong in a decade. This difference in time perception separates speculative behavior from investment behavior. Speculation focuses on price trajectory. Investment focuses on value durability. Buffett's partnership performance reflected this shift. Returns were steady. Drawdowns were controlled. Investors began trusting his consistency. But consistency required psychological resilience. There were periods when his style was unpopular. Market trends favored aggressive growth stocks. Analysts criticized conservative strategies. Yet Buffett resisted adaptation for popularity. He did not measure success by comparison. He measured it by alignment with principle. Another structural evolution occurred during this stage. Buffett moved from buying cigar but companies, businesses with one last puff of value, toward acquiring ownership stakes in companies with long-term competitive advantages. This transition would later define Berkshire Hathaway's identity. Why settle for temporary discount when you can own enduring strength? The answer involved compounding. Compounding is not dramatic. It is incremental. It multiplies over time quietly. But for compounding to function, the underlying business must sustain profitability. Thus, Buffett's philosophy integrated three pillars: rational valuation, quality assessment, long-term horizon. Together, these pillars created a disciplined framework. By the end of this formative period, the famous quote was no longer merely observational. It had become strategic. Price is what you pay. Value is what the business generates over time. This understanding positioned him for the next stage, the stage where Berkshire Hathaway would transform from a struggling textile company into a diversified, holding enterprise. The foundation had been built. The structural model was forming, and the psychological discipline required to execute it was already in place. Now the philosophy would begin shaping institutions, not just portfolios. When Warren Buffett assumed control of Berkshire Hathaway, his philosophy was no longer theoretical. It had moved beyond observation and early experimentation. It was entering a phase of structural implementation. This stage of his life represents a transformation from investor to capital architect. At first, Berkshire Hathaway was not an impressive enterprise. It was a struggling textile manufacturer operating in an industry facing irreversible decline. The purchase itself was not a grand strategic vision. It was initially motivated by perceived undervaluation. The company's assets appeared to exceed the market price of its shares. From a statistical perspective, it seemed rational. But over time, Buffett recognized a deeper structural problem. A business can be statistically cheap, yet economically fragile. Owning a declining company, even at a discount, consumes energy and capital. The lesson was not immediate, but it was powerful. He began to understand that value is not only about what something costs relative to assets. It is about future earning capacity. Future earning capacity determines sustainability. This realization shifted his investment focus toward businesses with predictable cash flows and durable economic advantages. The textile operations were gradually phased out, and capital was redirected into industries capable of generating long-term returns. Insurance became the strategic core. Insurance businesses collect premiums before paying claims. This creates a pool of capital known as float. Float is unique because it provides investable funds that do not belong permanently to the company, but can be used productively in the meantime. If underwriting is disciplined, the cost of float can be minimal or even negative. This structure fascinated Buffett. Float, when invested wisely, multiplies value. However, float is not automatically valuable. It must be allocated rationally. Poor decisions can destroy the advantage. Therefore, capital allocation became central to Buffett's evolving philosophy. He began analyzing businesses not only for current earnings, but for their ability to reinvest retained earnings at attractive rates of return. A company that generates profits but cannot deploy them effectively limits long-term compounding. In contrast, a company that consistently reinvests at high returns creates exponential growth over decades. Compounding is mathematical, but its execution is psychological. Markets move quickly. Investors react emotionally. Price fluctuations dominate headlines. But compounding rewards patience and discipline. It requires resisting short-term noise in favor of long-term structure. Why does price volatility disturb so many investors? Because volatility triggers emotional responses. It creates urgency. It suggests instability. Yet volatility alone does not equal value destruction. If intrinsic earning power remains intact, temporary price declines may represent opportunity rather than danger. Buffett strengthened his internal framework during this period. He refined 3 interconnected pillars. First, intrinsic value must be estimated through careful analysis of future cash flows. This requires conservative assumptions, not optimism. Second, management quality must be evaluated. Honest and rational leadership determines whether capital will be deployed intelligently. Third, competitive durability must be assessed. A company without protection against competition will struggle to sustain margins. These pillars transformed his investment approach from opportunistic discount hunting to strategic business ownership. He began emphasizing economic moats, structural advantages that protect profitability. Moats can appear in different forms. Brand loyalty can create pricing power. Network effects can reinforce market dominance. Regulatory barriers can limit entry. Cost advantages can discourage competitors. Without a moat, growth is fragile. With a moat, growth becomes durable. This transition explains his increasing preference for companies such as Coca-Cola and American Express. These businesses possessed not only strong financial statements, but enduring consumer trust. The quote, "Price is what you pay, value is what you get," gained new depth in this context. Price represents a transaction. Value represents the present worth of future cash generation. The distinction requires intellectual effort. It requires modeling future scenarios. It requires understanding industry structure. It requires separating temporary conditions from permanent impairment. Buffett also adjusted his view on diversification. Conventional financial theory promotes wide diversification to reduce risk. Buffett argued that excessive diversification often reflects insufficient conviction. If you truly understand a business and believe in its durable economics, concentration may enhance return. Diversification protects against ignorance. Concentration rewards insight. This view did not encourage recklessness. It required rigorous analysis before commitment. Buffett spent extensive time reading annual reports, studying management history, and evaluating long-term competitive position before allocating capital. Time horizon further reinforced his advantage. Short-term traders measure performance quarterly. Buffett measured progress over decades. Extending the time horizon reduces the relevance of daily fluctuations and highlights structural growth. Time magnifies disciplined decisions. As Berkshire accumulated capital, Buffett demonstrated restraint during speculative booms. He avoided trends he did not understand. He refused to pursue popularity. This discipline often resulted in temporary underperformance relative to fashionable sectors. Yet long-term outcomes validated patience. Restraint is often mistaken for inactivity. In reality, restraint is strategic selection. During this stage, Buffett was no longer simply investing. He was constructing a self-reinforcing capital system. Insurance float funded acquisitions. Profitable subsidiaries generated additional cash. Reinvested earnings compounded. The architecture was stable. By the end of this phase, the philosophy was fully integrated into Berkshire's operational DNA. Price fluctuations no longer dictated strategy. Intrinsic value estimation guided decisions. The structural transformation from investor to allocator was complete, and the famous quote had matured from observation into operational principle. Price signals opportunity. Value determines action. As Berkshire Hathaway expanded, Warren Buffett's philosophy evolved from personal strategy into institutional culture. Managing billions of dollars required more than analytical skill. It required building a system capable of sustaining rational behavior across decades. One of Buffett's most distinctive decisions was decentralization. Berkshire subsidiaries operate with significant autonomy. Managers are trusted to run daily operations without excessive interference from headquarters. This structure reflects Buffett's belief that value creation depends on competent and ethical leadership at every level. Control can preserve efficiency. Trust can preserve culture. Buffett selected managers based not only on financial performance, but on integrity and long-term orientation. He often acquired companies whose leaders were already deeply committed to their businesses. By allowing them independence, he avoided bureaucratic slowdown. This approach reinforced intrinsic value. Financial statements reveal quantitative performance. Corporate culture influences qualitative sustainability. Culture is invisible on balance sheets, yet it shapes decision-making. A disciplined culture encourages rational capital allocation, cost control, and ethical consistency. These elements compound over time, just as financial returns do. Why does culture matter in valuation? Because culture influences future cash flows. Poor ethical standards increase risk. Short-term manipulation damages trust. Trust, once broken, reduces customer loyalty and employee engagement. Buffett frequently emphasized reputation as a fragile asset. He famously advised managers to avoid any action that would embarrass the company if publicly revealed. This principle protects long-term value even when short-term incentives tempt otherwise. He also refined capital allocation discipline during market cycles. Markets alternate between optimism and fear. In euphoric phases, valuations detach from underlying earnings power. During crises, fear drives prices below intrinsic value. Buffett's response was systematic rather than emotional. When others become greedy, valuations inflate beyond reason. When others become fearful, undervaluation emerges. But exploiting these cycles requires preparation. Berkshire maintains substantial liquidity. Cash reserves provide optionality. Optionality enables decisive action during dislocation. During the financial crisis of 2008, Buffett deployed capital into major financial institutions under structured agreements. These investments provided strong downside protection and attractive upside participation. While markets panicked, Berkshire acted. What allows calm behavior during collective anxiety? Preparation and conviction. Preparation involves liquidity and analysis. Conviction arises from understanding intrinsic value clearly enough to withstand temporary volatility. Another important evolution during this stage was Buffett's acceptance of scale constraints. As Berkshire's asset base expanded, small opportunities no longer influenced overall performance. Scale limits flexibility. Identifying large, durable investments became increasingly difficult. Instead of chasing marginal opportunities, Buffett prioritized quality and size. He preferred allocating significant capital to a few strong businesses rather than spreading resources thinly. Scale demands discipline. Large institutions often drift toward complexity. Buffett resisted unnecessary complexity. His annual shareholder letters demonstrate remarkable clarity. He explains reasoning in accessible language without oversimplification. Clarity reduces speculation. Transparency reduces volatility. By openly acknowledging mistakes, Buffett strengthened credibility. Admitting error enhances trust. Trust stabilizes investor expectations. Stable expectations protect intrinsic value from emotional distortion. His later investments, including technology companies previously avoided, illustrate adaptive discipline. For years, he refrained from investing in technology because he believed rapid innovation created forecasting uncertainty. However, once certain companies demonstrated durable ecosystems and recurring revenue streams, he reassessed. Adaptation does not mean abandoning principle. It means applying principle to new conditions. The core principle remained consistent. Estimate intrinsic value conservatively, demand margin of safety, and prioritize durability over excitement. He also emphasized simplicity. Complex financial instruments may promise enhanced returns, but introduce opacity. Buffett prefers businesses he can understand clearly. Complexity increases error probability. Simplicity enhances resilience. As Berkshire matured, Buffett's philosophy influenced generations of investors. Value investing became a widely recognized approach. Yet many misunderstand its discipline. Buying cheap assets without assessing quality is incomplete. Ignoring management integrity weakens analysis. Short-term impatience undermines compounding. True value investing integrates multiple dimensions: quantitative valuation, qualitative durability, psychological discipline, long-term horizon. The quote that began as an observation now functions as an integrated framework. Price reflects current sentiment. Value reflects accumulated earning power. Earning power is shaped by competitive position, managerial integrity, reinvestment capability, and industry structure. Evaluating these components requires both data and judgment. Buffett's later years illustrate philosophical consistency rather than dramatic change. He continues to emphasize patience, rationality, and long-term thinking. He resists leverage, prefers conservative balance sheets, and avoids speculative frenzy. His legacy is not extraordinary risk-taking. It is extraordinary consistency. Consistency, when applied over decades, produces compounding results that appear extraordinary only because few maintain discipline long enough to experience them. In the final analysis, Warren Buffett's philosophy transforms a simple sentence into a comprehensive system. Price is what you pay. Value is what endures. Endurance requires structure. Structure requires discipline. Discipline requires emotional control. And emotional control depends on clarity of principle. This is the mature stage of his investment architecture. Not reactive, not impulsive, not dramatic. Structured, measured, sustainable. In the later decades of Warren Buffett's career, the discussion about his success gradually shifted. It was no longer only about stock picking or percentage returns. It became a deeper examination of mindset, structure, and long-term discipline. Observers began to understand that his achievement was not built on isolated, brilliant decisions, but on a consistent framework sustained over time. At this stage, Buffett represented something more than a successful investor. He represented a philosophy of rational behavior in an irrational environment. Markets are driven by human emotion. Fear spreads quickly. Excitement spreads even faster. Media amplifies extremes. Short-term movement dominates attention, yet intrinsic value evolves slowly. The contrast between emotional speed and economic reality creates distortion. Buffett's advantage was not superior intelligence alone. It was emotional stability. Emotional stability allows analytical clarity. Many investors know valuation principles. Fewer can apply them when pressure rises. During crises, the psychological environment changes. Prices fall rapidly. News becomes negative. Social validation disappears. In such conditions, the temptation to abandon rational frameworks increases. Why do intelligent people make irrational decisions under stress? Because emotional intensity narrows perspective. Short-term pain feels permanent. Temporary volatility appears catastrophic. Without disciplined structure, reaction replaces reasoning. Buffett constructed habits to counter this tendency. He limited exposure to daily noise. He focused on long-term earnings reports rather than hourly price changes. He evaluated businesses as if markets might close for years. This mental model shifts attention from fluctuation to fundamentals. He also cultivated independence. Popular opinion rarely influenced his decisions. Instead of asking what others think, he asked what the data and structure suggest. Independence reduces social pressure. Reduced pressure protects rational judgment. At Berkshire Hathaway, this psychological architecture became institutionalized. The company avoided excessive leverage. Debt magnifies volatility. Volatility increases emotional strain. By maintaining strong liquidity, Buffett reduced forced decision-making. Forced decisions often destroy value. Liquidity creates choice. Choice supports patience. Patience enables disciplined action when opportunity appears. Another significant evolution in Buffett's later career involved the concept of circle of competence. He frequently emphasized operating within areas he understands deeply. This concept is deceptively simple but psychologically powerful. Knowing what you do not know prevents overconfidence. Overconfidence leads to mispricing risk. Mispriced risk leads to structural loss. By clearly defining boundaries, Buffett avoided unnecessary exposure. He did not chase industries outside his analytical reach. In this sense, discipline was not restrictive. It was protective. As global markets became increasingly complex, Buffett maintained preference for businesses with understandable revenue models and durable competitive advantages. Complexity does not guarantee value. In fact, excessive complexity often obscures weakness. Clarity enhances durability. Observers sometimes criticize Buffett for avoiding rapid technological speculation in earlier decades. However, this restraint reflects alignment between principle and competence. Later, when certain technology companies demonstrated stable ecosystems and recurring cash flow patterns, he reconsidered. Adaptation without abandoning core philosophy represents maturity. Another defining element of this stage was succession planning. As Buffett aged, attention turned to Berkshire's future leadership. He openly addressed succession in shareholder letters. Transparency reduced uncertainty. Reduced uncertainty stabilized long-term valuation. Leadership continuity influences perceived value. Investors discount future earnings when governance risk increases. By proactively structuring leadership transition, Buffett protected shareholder confidence. Beyond financial markets, his influence expanded into philanthropy. He pledged the majority of his wealth to charitable causes, emphasizing societal responsibility. This action reframed wealth as stewardship rather than accumulation. Value, in its broadest sense, extends beyond financial return. Capital allocation becomes ethical allocation. Buffett's life demonstrates that disciplined compounding applies not only to money but to reputation and impact. Ethical consistency compounds trust. Transparent communication compounds credibility. Rational leadership compounds stability. The famous quote about price and value, when viewed from this stage, represents layered meaning. Price is observable. Value is interpretive. Interpretation requires context. Context requires analysis. Analysis requires emotional stability. Emotional stability requires principle. This chain explains why Buffett's philosophy appears simple, yet functions with depth. His later career reinforces a final psychological truth. Long-term success depends less on predicting the future precisely and more on constructing systems resilient enough to endure uncertainty. Resilience is superior to prediction. Prediction demands accuracy. Resilience tolerates error. Buffett structured Berkshire to withstand economic downturns, industry shifts, and leadership transitions. By emphasizing durable businesses, conservative balance sheets, and disciplined capital allocation, he reduced vulnerability to unpredictable events. In the documentary arc of his life, this stage reflects consolidation. The individual investor became institutional philosophy. The childhood observer became global example. The system matured, and the quote endured. Price is what you pay. Value is what remains. As Warren Buffett's career approaches its later chapters, his philosophy stands less as a set of investment rules and more as a framework for rational decision-making across domains. The cumulative effect of decades of disciplined application reveals a replicable structure. The structure begins with clarity. Clarity about intrinsic value. Clarity about time horizon. Clarity about competence boundaries. Without clarity, price dominates perception. With clarity, value guides action. In synthesizing his life's work, several interconnected principles emerge. First, valuation must be anchored in future earning power. Historical data informs understanding, but future cash generation determines intrinsic worth. Estimating future earnings requires conservative assumptions and structural awareness. Second, competitive durability must be prioritized. Temporary growth without structural protection invites erosion. Durable businesses possess moats that protect margins and market share. Third, management integrity is non-negotiable. Ethical behavior protects long-term value. Short-term manipulation destroys it. Fourth, psychological discipline determines execution. Analytical frameworks collapse under emotional instability. This structure explains the sustainability of Buffett's performance. Many investors can identify undervalued assets temporarily. Few maintain discipline through market cycles. Discipline compounds over time just as earnings do. Consider the role of time. Time amplifies rational behavior. Time punishes inconsistency. Small analytical advantages, when applied repeatedly over decades, produce exponential divergence from average outcomes. Compounding magnifies difference. But compounding requires uninterrupted application. Interruption often arises from emotion. Fear interrupts holding. Greed interrupts prudence. Social pressure interrupts independence. Buffett minimized interruption. He also demonstrated humility. He admitted mistakes publicly. He avoided claiming infallibility. Humility supports learning. Learning refines analysis. Refined analysis strengthens value estimation. Is perfection required for long-term success? No. Consistency within a disciplined framework suffices. Another synthesizing insight concerns simplicity. Complex strategies may appear sophisticated, yet simplicity grounded in fundamental economic principles often outperforms. Simplicity clarifies cause and effect. When you understand how a business generates profit, how it reinvests capital, and how it protects competitive position, valuation becomes grounded rather than speculative. Buffett's later years emphasized legacy. His letters increasingly focus on culture, succession, and institutional resilience. This shift underscores that value extends beyond numbers into continuity. Continuity stabilizes expectations. Stable expectations protect intrinsic value. His philanthropic commitments also reinforce an expanded interpretation of value. Wealth accumulation without societal contribution lacks dimension. By pledging substantial resources to charitable causes, he reframed capital as a tool for collective benefit. This perspective completes the philosophical arc. Price measures transaction. Value measures impact. Impact can be financial, cultural, ethical, or societal. When aligned, these dimensions reinforce one another. From a documentary standpoint, Warren Buffett's life illustrates that extraordinary outcomes emerge from ordinary discipline repeated consistently. The snowball metaphor often used to describe compounding captures the process visually. But the underlying engine is rational structure. Structure prevents deviation. Deviation reduces compounding. Compounding creates magnitude. In final synthesis, the quote that began as a distinction between price and value becomes a universal lens. Price reflects the present moment. Value reflects cumulative substance over time. Substance is built through rational choice, ethical integrity, disciplined allocation, and emotional stability. These principles are transferable. They extend beyond investing into career decisions, leadership development, and personal growth. Long-term success rarely depends on dramatic breakthroughs. It depends on minimizing error, preserving capital, and compounding advantage patiently. This is the enduring lesson of Warren Buffett's intermediate narrative. Not brilliance alone, not speed, not excitement, but clarity, structure, discipline, time. And in that disciplined time horizon, value inevitably separates itself from price.